So, hello everyone. Firstly, I'd like to thank FxCuffs for inviting us to speak here today. It's a great privilege to be amongst you all, and it surely looks like an amazing FX show that you have on here today. So, my name is Michael Madden, as you've been told. I'm the Senior Cross Rates Analyst at Elliott International. As you can tell from my accent, I'm not from Atlanta, Georgia, where Elliott International are based, but I work remotely from Ireland, thanks to modern technology and the way the financial markets can be accessed now from our homes and anywhere really. So I've been studying technical analysis since about 2008, and a lot of that time was devoted to the Elliott wave principle. Throughout that time, as you've heard, I obtained some industry-recognized qualifications, and I now work as a full-time Elliott wave analyst. So, in today's presentation, I want to show how we use the Elliott wave principle within the Forex markets, or with any market in general, to come to certain junctures and certain turning points. And I'm going to take a look at the long-term trends within some of the major currency pairs, and we're going to see how we got to where we are now, what kind of a juncture we're at, and where we expect the markets to trade in the coming weeks to months, or how healthy the trends are that are currently underway. So, the markets I will cover today will be the US dollar index, Euro US dollar, the US dollar Japanese yen, and seeing as I was in Poland, I had a look at some of the zloty, I hope I'm saying that right, pairs, and I came across the Euro zloty, and it appeared to be at an interesting juncture. So we'll have a look at that at the end. I'll take some questions at the end of the presentation, so we'll get through it now. So the wave principle is a form of technical analysis that Ralph Nelson Elliott originated in the 1930s. He discovered that stock market prices trend and reverse in recognizable patterns, and that these patterns then go on to make larger patterns and smaller patterns of the same. He went on to codify the principle, and he came up with 13 such patterns. Within them patterns, there are 5 core patterns. And even with them 5 core patterns, we can break it down into 2 phases, a motive phase and a corrective phase. The motive phase defining the trend, and the corrective phase then trades against the main trend. So like I said, we have motive waves divides into 5 waves, 1, 2, 3, 4, 5, and a corrective phase divides into 3 waves. You'll notice that the motive wave, we use numbers to label it, and then on the corrective phase, that is labeled with letters. So at a quick glance, you can understand where the trend is. The main trend is labeled using letters. So as I said, of the 5 core Elliott wave patterns, we can divide them into 2, the motive waves into 2, and they consist of 5 waves, and they're broken down into an impulse pattern and a diagonal. The impulse pattern is by far the more common 5-wave pattern, and it is the sequence that we were kind of more or less look out for when we're counting 5 waves. So here's just the 5 waves for our motive waves. Another thing just to remember, like when we talk about trends, I'm not just talking about an uptrend. Markets trend upwards and markets trend downwards. And as a trader, like it's very important that when a market changes to a bear trend, that you're able to just switch your analysis and focus on the trend to be down as opposed to being up. So here we have an example of a bullish impulse advance. And then on the right, we have an advance 5 waves again on a bearish impulsive decline. Here are the less common diagonals a bull market diagonal, and a bear market diagonal. So to apply the wave principle correctly, there are only 3 rules, but these rules must be adhered to, and we refer to them as the cardinal rules of the wave principle. Rule number 1, wave 2 cannot retrace more than 100% of wave 1. Of the 5 waves of the impulsive advance, waves 1, 3, and 5 can never be, or wave 3 can never be the shortest, and wave 4 can never end in the price territory of wave 1. So what do I mean by that? So we look at our wave 1 advance. When wave 2 is correcting, this wave 2 cannot come down and retrace more than 100% of that first wave. Following the wave 2 correction, we look for another 3 waves to advance. Once them 3 waves are in place, the 4th wave correction cannot end in the price territory of this wave 1 high. Then when the 4th wave ends, 5 more waves advance to complete the 5-wave structure. We would refer to this 5-wave structure as a larger degree trend to this initial wave 1, which is a 5-wave structure. And once this 5-wave structure completes, we expect a 3-wave retracement to correct the 5 waves, and this 3-wave retracement must not retrace more than 100% of them 5 waves. And again, just to get you familiar with the idea that trends, bear trends and bull trends, wave 1, 5 waves down, wave 2 must not retrace more than 100% of this wave 1. Wave 3, it's never the shortest wave, can never be the shortest. It doesn't necessarily have to be the longest wave of the 5 waves. And we have our 4th wave, does not enter into the price territory of wave 1, and we have 5 waves down then to complete the larger degree 5-wave structure. So after this, we would expect a correction. So if we have 2 motive waves, we then have 3 corrective waves of the 5 core patterns, and they are the zigzag, the flat, and the triangle. Sometimes these patterns do not retrace enough or do not offer enough of a correction for the 5 waves they are correcting, so they will often link in or create a larger pattern, but they use the 3 core patterns to do this. The zigzag being one, where you might have 1, 2, or 3 zigzags. A 3rd zigzag is very rare, so we normally look for a double zigzag, or a combination. A combination would be a sideways affair. They're normally shallow, and they consist of either of these 3 patterns linking together. So just here's a breakdown of our idealized corrective patterns. The first one is the zigzag. So I don't want to get too involved in the internals of these patterns and stuff. What I want you to recognize today is that a corrective pattern is a 3-wave pattern. We refer to them as trees. So we have 5 waves down for an A wave, a 3-wave correction, and another 5 waves. But the important thing is that this whole pattern consists of 3 waves. It's corrective. Again, the flat, this is different because it starts with a 3-wave move itself, but the larger pattern is a 3-wave affair. The triangle is a little different, is that it consists of 5 waves, but it makes no progress in the direction of the larger degree trend that it's correcting. So the pattern consists of all 3-wave structures, mostly zigzags, and it's a sideways pattern, and it tends to have trend lines that converge, which makes it an easy pattern to recognize. Again, we have an example of the combination. So here we have a flat, a zigzag, and a triangle. As you can see, it's a sideways affair, and it's quite choppy and overlappy in nature. And that's one thing. If you're not familiar with Elliott, or you have a small bit of Elliott, the one thing I would say that you should take away with you today, or that you should always come back to when you're thinking the Elliott wave principle, is corrective structures are overlappy, they're choppy affairs. They're often referred to as sloppy because price action is chopping around, and they're counted as trees. So we think of a 3-wave move. You can't count a 5-wave move here, So to put it simply, if it's not a 5-wave move, it must be 3, it must be corrective, and it's trading against the main trend at larger degree. Here now is just a breakdown of them patterns. So on a bull market, we are over 5 waves unfolding to the upside, and a zigzag would fold against that, downwards, 3 waves. So if you had 5 waves up, a flat pattern fold against it, triangle sideways, and here's a double zigzag, but combination double zigzag is still very corrective and choppy. It'll be corrective. And then in a bear market, 5 waves down, indicating that the trend is now turned down. A zigzag will unfold upwards against these 5 waves, same as a flat pattern would, a triangle, and a combination. Oh. So our basic building block that we looked at originally with our 5 waves up and our 3 waves down. 3-wave correction, it ends without retracing 100% of the first wave. Once this correction is in place, we would expect to see another 5 waves to unfold in the direction of the main trend. When these 5 waves complete, like any 5-wave pattern, we would expect a correction. If this correction unfolds and does not enter or end in the price territory of the first wave, the first 5 waves, we would go on then and look for another 5 waves to advance. These 5 waves then would create a 5-wave pattern at larger degree to this initial 5-wave pattern. After that then, we would expect a 3-wave correction to unfold that would unfold larger and take up a lot more time than any of the 3-wave corrections that unfolded within that 5-wave pattern. That's how we recognize that this 3-wave pattern is part of this 5-wave advance. So I just bringing you back to the basic building block. That 5-wave advance was that 5-wave advance. So here we have just more detail. So again, one 5-wave completes. Now we have 3 degrees of trend here, and we're looking for a larger correction. So as I said, the trend is defined by 5 waves. A correction unfolds in 3 waves. Corrections are choppy, 3-wave moves. They make no progress in the direction of the larger degree trend. And that's how we use our rules and guidelines to be aware of this. So with that much information, which is quite a condensed Elliott wave overview, that is basically it. There are the 5 waves. There are the 5 core patterns, and we know that corrections unfold in 3s. We have the 3 rules, and if we stick by them, you know, it'll keep you out of a lot of trouble, and you could learn to use this quite successfully. So I'm going to use that information. I'm going to look at the US dollar first, and we're going to see how we use that information to keep our subscribers on the right side of the trend. And to do this, I'm going to have to go back in time. That's the other benefit with a model like this, like the wave model, is that because of its simplistic nature, the 5 waves up and 3 waves down, and that is the basic building model, we can go back and look at a yearly chart, a quarterly chart, or a monthly chart, and get a context as to what is actually going on with that market. Because we're looking for a 5-wave advance and a 3-wave correction, or a 5-wave decline, or a 3-wave correction, or perhaps just a correction. So when we go way out and we can look at it, we get an idea of where is the trend in this market and what do we expect the trend to do. So when we go back to 2008, and again, all these charts that I'm using today, they were all published in real time with the Forex product with Elliott Wave International. I wasn't working at the time, so I'm not responsible for this, but anyway, I remember a lot of it going on at the time. So, after looking at our patterns, this decline here can be counted as 3 waves, a zigzag, and then from this low it put in 2008, I'm actually just going to go 70.70. I won't say dollars or euros or whatever, I'll just use the figure. So 70.70, we had quite a sharp advance. So if corrections are sideways, choppy affairs, impulses tend to be sharp, they move quite quickly, and they advance or decline in quite a quick manner. So this really brought to our attention at the time, or to an analyst's attention at the time, that the chances were that this three-wave move that was underway since 2001 was most likely in place. But this was not enough to really have confidence in the idea that that's it, it's done. As you remember, we have 5 waves up and a 3-wave correction is our basic building model. So this low is quite important. And another benefit of the model is it gives us key levels or critical levels that if price retraces through that level, not by 5% or 10%, by 1 pip, your analysis is wrong. You need to step back, reevaluate the chart, and see what is actually happening. So automatically, that's a great thing to know as a trader. You need to know, where am I wrong? You're wrong here at 70.70. So anyway, we had we're considering 5 waves up here, but the impulsive nature was what was most interesting. Again, we're moving on now to December 2009, and since that impulsive looking advance, price corrected in what we were labeling a 3-wave correction. It was quite a deep correction, and it didn't come down and take out the 70 low. So we were on the lookout for maybe another 5-wave advance was underway. The actual impulsive nature of the price action from the wave B low is just indicating that maybe this 3-wave correction is in place. I just wanted to show you, so this is what we're basically looking at. We're looking at a 5 waves up and a 3-wave correction in place. That's what, real life examples are not going to be the same as what's in a book, but you can get the basic picture. And price did take off in quite an impulsive manner, which was quite exciting at the time. And as you can see by the labeling, which had been labeled just an ABC, which would be more conservative, where we would be thinking 5 waves up, 3-wave correction, another 5-wave advance with equality projection, A equals C move. We now have a 1-2 because of this impulsive looking advance, thinking that the dollar has put in quite a significant low. Price came up, tested the wave 1 high, and retraced. With my explanation of the wave principle, I wanted to keep it as basic as I could, but when EUR and Elliott published a book called Nature's Law, he came up with the concept, or he figured out that the wave principle was governed by the Fibonacci measurements. And what is really interesting about that is he didn't try to fit the Fibonacci to suit his model or have Fibonacci and try and place it into it. He figured out the patterns, and a bonus to his discovery was, oh my God, Fibonacci is actually the basic measurements, the building block to this, which is quite amazing altogether. So what we would be considering our 5 waves up or 3-wave correction, we're looking for another 5 waves to unfold if the larger degree trend is up. And price came down, it's testing a 0.618 Fibonacci retracement of this advance, something that we would look for a wave 2 to locate support. And we were probably very bullish at this stage. But what was a bit of a concern was wave 3 did not take out the wave 1 high. The third wave within the 5 waves is the strongest wave. It's generally the sharpest wave of an impulsive advance. It doesn't have to be, but it generally is. But it is the strongest wave. It's the wave that everybody comes in and realizes there's a trend underway. So when price did not take out the wave 1 high, we were probably a little concerned, but we would have given it at least a 50% or a 0.618 Fibonacci retracement to see, is it a 1-2? And it wasn't. But going back to what we said about 5s and 3s, and keeping it simple, and basically, can I count to 5? If I can't count to 5, it must be a correction. If it's a correction, it's trading against the trend at larger degree. So, we've 3 waves down here. This is quite an impulsive looking advance, but then again, you know, we can put a 3-wave count on it. But the retracement that came back down is another very definitive 3-wave decline. So our 70 level is still intact. We have an impulsive advance. We have a corrective retracement, 3 waves, and we have it labeled now as our combination. So 2 corrective patterns get linked together. So what we were, and well, just while I'm here, because I'm such a fan of channeling, if you want to take note of this also, corrective waves tend to unfold within the boundaries of a price channel. So when a correction is underway, once we can establish channels, we look for price action to come down and test the boundaries of these channels. And you can see here that this is exactly what happened, and we're getting a reaction off the lower boundary. I said also that the wave principle gives us key and critical levels, and that it does. And here you see the 70 level. So what we're expecting here, if this is a 1-2, we're expecting the dollar to really prove itself and to take off. But if you just come across this chart now and you hadn't spent the last year or so analyzing or looking at it, the risk is minimal to what the expectations are, and the risk is defined. So that's a discussion for another day. I'll be talking about that tomorrow. But I just wanted to show you that. So the advance of this, the lower boundary of our corrective price channel, the corrective nature, and the wave 1, we're now actually gone very bullish. We've forgotten about the ABC. We're labeling it a wave 1, 2. We're getting quite bullish. And what we do, or what you should do, or what we do within a service is like, we will raise our key support levels that we would expect price to adhere to if we are correct on the trend. And that's what these levels are here. So as we don't really have our 5-wave advance in place here, we're raising key levels to say, if this larger degree correction is in place, price really needs to start holding these levels and starting to push higher. And we'll keep monitoring price and see the 5 waves unfold. So now I've just zoomed into a weekly chart, and that's what did happen. Here is the less common 5-wave pattern, the diagonal. But even if you didn't label it as a diagonal, the price action that followed is overlappy, it's corrective, it's sideways, and it's not making any progress really in a downtrend. So we're still considering the trend to be up, and we put a lower degree 1-2 label on it. The key levels that we were shown on the sorry. So the key levels we were shown on our monthly charts. So we've our 70.09, and we've a 70.60 here. We had a zone there, and we're counting 3-wave sideways move, thinking the trend is up, and price is now going to prove itself if this is corrective. And with a labeling like this, where you're looking for the most powerful wave to unfold, you really want price to start to prove itself. And that is another benefit, that you have the ability to expect price to do something. So if you're looking for a 3rd wave advance, which is supposed to be the strongest and the sharpest move, and it's not happening, and it's not, price just chops around and meanders sideways, or it goes up and comes down, you can't count 5 waves, your analysis is wrong. But if it does, your confidence grows that all the previous labeling that's behind you is most likely correct, and it's given you the ability to add to positions or initiate new positions or whatever. So it's great benefit to get confidence in previous analysis. And that's exactly what was happening here, and what we would have been telling subscribers to expect, and what needs to happen to tell us that this is right. And price starts to lift off in quite an impulsive manner again. We can count 3 waves complete, a sideways pattern. We're looking for price to now shoot to the moon, as they say. And bingo, that's what happened in real time. So we're getting confirmation now that a third wave is underway, that our 1-2 labeling that has been going on since the 2008 low, the 70.7 level, is right. Well, most likely right. And we're raising key levels, and we're looking for 5 waves now to unfold for our third wave. And that's what happened. Here's our 1-2 count. Here's where we were looking for price to take off of that third wave. And there's the sharpest move, the strongest move within our structure. And since then, price has retraced in 3 waves. Corrective, trading against the trend at larger degree, which is up and which we're getting confident about. And it's turning into a sideways affair. So what we seem to be happening here is we're getting back to back to back corrective patterns, which is indicating perhaps a triangle is unfolding. I referred earlier to the 3 rules of the wave principle, but we do have a number of guidelines, and so at certain patterns or certain junctures, there are certain guidelines that we like to adhere to. They don't have to adhere to them. They have to adhere to the rules. Rules are rules. Guidelines, not so much. But a strong guideline is the 4th wave can often unfold as a triangle. And that's what appears to be happening here. That is our update currently underway. And what we're expecting for the dollar, as the 5 waves for the triangle are not countable at the moment, do not appear to be in place, we think wave C might be, but it seems a bit short. But we need A, B, C, D, and E of this pattern to unfold. And once it unfolds, we expect price to thrust out of the pattern. Because like any traditional technical analysis, if you're into patterns but not into Elliott, a triangle is a continuation pattern. And that's basically what's happening here, and we're expecting price to push higher. So our outlook for the dollar is sideways to bullish, but with the larger degree trend behind us, we remain bullish the dollar. Just while we're talking about it, and we're talking 5s and 3s, once this 1, 2, 3, 4, 5, once this 5 wave advance completes, then price will roll over and have to correct it. So it will correct in 3 waves. So there's quite a bit of information that's coming with this sideways pattern, this triangle. We're getting the information that we expect prices to push higher, thrust out of the pattern in 5 waves. So once these 5 waves are in place for wave 5, these 5 waves at larger degree are going to be in place. And the dollar will likely take a good hit at that stage. But anyway, that's probably years to come, or 2 or 3 maybe. Just here's back to where we started now. This initial impulsive advance in a monthly chart, a 3-wave correction, and this is the 5 waves that we appear to be unfolding here. Again, we're kind of taking a little conservative view here by labeling it A, B, C, because if we were to label this 1, 2, 3, it would just be, you'd be looking, well, there's no real need for it to be too bullish. What happens after the 5 waves are in place will indicate us then if another 4th wave at larger degree is underway, or if a more substantial correction is taking place. But as I said, additional price action will give us more information for us to help analyze that. So that's one of the things I just want to show. I'm back to a monthly chart as well. Is that like these are the charts that define the trend. So you go back to you could go back yearly charts. The trend originates. This is what's governing all down, down, down as we go from monthlies to weeklies to dailies to like 700-minute chart, 240-minute chart, 60-minute chart, 5-minute chart. My own personal opinion that when it comes to Elliott or even trading in general, newcomers or even people that are in the markets, they like to focus on the small little stuff, and then they're trying to put that into context and build the big picture, where it's all about taking a step back and looking at the larger degree trend, the larger degree pattern. Is it corrective or is it in 5 waves? And then zooming down, and trying to locate then the small patterns that are unfolding within that larger degree pattern stroke trend. So that's the US dollar. I'm going to move on to the euro now. Euro US dollar. So a lot of you are probably aware of the high correlation between the US dollar and the euro US dollar index. And just another misconception that some traders or analysts can get into when analyzing correlated markets with the wave principle is they try to blend two counts to replicate one another because there's such a high correlation within the market. And that is something that you should stay well away from. When counting markets using the Elliott wave principle, you should count each market on its own individual basis. If markets are correlated, like the dollar and the euro US dollar, you're going to look for, well, you should see wave patterns within one market that complement your outlook in the other market. You know, so that's confirming both counts, but you're not looking for the same wave count in all these markets. And you can see now when we look at the euro US dollar. Again, we're zooming out to a monthly time frame. We're counting 3 waves up. You can count the zigzag complete. But what's interesting of the 2008 high is this sharp, impulsive looking advance, warning that like the correction that has been underway since the 2000 low is most likely in place, and a trend reversal is possibly underway. But with sharp, impulsive advances, that's not when we're going to jump in on the market and try and get involved and get hurt. We want to see price trade against the impulsive advance and unfold in a corrective manner, and if we can count it in 3 waves, there's a good chance the trend has turned down and that the larger degree trend will continue down. And from the impulsive advance or decline, we have 3 waves labeled here as a B wave, which is indicating the trend is down. And we have a sharp move, which we're labeling a 1-2 of a 5 waves to unfold for wave C, quite a bearish outlook. But there was reason to look that way. We had a key level here at the wave B high. Price could not retrace more than 100% of wave 1. So we knew where we were wrong. The risk was minimal here after you waited for your corrective pullback. And moving on now, while we were that was wrong. So the highlighted box here is showing the move down that we were considering, the 1-2, and price came back up, retraced the wave 1 by more than 100%, negated the count, said go back, look at your count again, and see what else is unfolding, because it's not what you thought. And we're still taking steps, still looking at this. This is in 3 waves, so the trend is down. This is okay. They put a wave 1 count, and you can count 1, 2, 3, 4, 5, but it's not. It's just as easy to put a 3-wave move and a 2. So we have a 3-wave advance now, up at what we were labeling wave C. We were able to establish more key and critical levels. The wave A high, we said, okay, if this is corrective, which we're thinking it's corrective because of that initial pullback, if it's going to be a triangle, price cannot take out the wave A high at 1.5147. So we let price come up, establish a trend line with this initial move down, and said to ourselves, if wave C of a triangle is in place, price has got to push lower now in 3 waves for wave D. Because a triangle has 5 waves, each of the waves are 3-wave affairs, and we need to see another 3-wave pattern to unfold here. So the bearish outlook stands with the 1.5147 high intact. Again, the retracement to our critical level is minimal. Our outlook is for a push down to maybe test the wave B low. So the risk to reward is phenomenal. And as I said, we're zooming in, we're zooming out. Here's a monthly chart just showing the wave C high and prices making a nice push down in wave D of the triangle. And a closer look. So that was the wave D that unfolded. Again, if you just had to look at that and you said to yourself, oh, what did he say? He said 5s and 3s, impulse. What are them rules? Oh, there's 3 of them. I'll look them up. You can't count that in 5 waves. You've got all these 3-wave patterns going back to back. Hang on now, trend lines, it's converging. Could be one of them triangle patterns. Okay, as I said earlier, there are guidelines that we use then to, and Fibonacci measurements that you can use to help define these patterns or look for certain waves to reach certain distances. I'm just highlighting our 3-wave moves there for the AC. And so wave D located its low here, 1.2042, and we're looking for a 3-wave advance then to complete the larger 5-wave triangle sideways pattern. The Fibonacci measurements I was just adhering to is within a triangle, the E wave of the triangle will often travel 0.618 times the distance covered in the triangle's C wave. So alternating waves within the triangle are related to each other by the Fibonacci 0.618 Fibonacci golden ratio. And we established that level at 1.3935, and price came up and tested it. So if price is starting to turn down from a cited level that we would expect the triangle to end at, we're going to get quite excited. And we can drill down into lower time frames to see what pattern is unfolding for that E wave and how them smaller patterns are doing with regard to their completion. So the E wave, we're labeling it as a double zigzag, so 2 zigzags that are linked together by another corrective pattern. Within that zigzag, the C wave is taking the shape of that diagonal pattern that other motive wave are referred to. A rare pattern, but an absolute gem of a pattern. Because when these patterns unfold, they often unfold as the final pattern within a larger degree trend. We refer to them as ending diagonals. Why they're so exciting is because they bring with them a lot of information. They're telling us the trend is getting exhausted and that it has gone too far, too fast, or there's just not enough to keep this market pushing higher. Once a diagonal completes, again, there's certain price action that we look for to happen to raise our confidence levels that this is the pattern that is unfolding, which is helping us to confirm the larger degree pattern, is that we look for price to reverse in a swift and dramatic manner and to retrace back to the origin of that pattern, the diagonal, which would be the wave B low here, in quite a quick manner. Normally, a third of the time it takes for the pattern itself to unfold, but they're just all these guidelines. So you have your converging diagonal pattern for wave C. You have all this other information that's going on with regard to all our monthly charts and our weekly charts and all the 3-wave corrections and our diagonals, or our converging trend lines for the triangle. So our first key level would be 13296, because if this level is taken out, the chances are it's confirming a 3-wave move is in place of this wave X, which is not included here now, but remember I referred to channels. I wasn't working there at the time, so there was no channeling going on. We could put our channels on here too, and if price did not locate support on the lower boundary of that channel, that's more information, more of a guideline information that our 3-wave correction is in place. So, bang, price action breaks out of the triangle. Another guideline I didn't refer to was when it comes to triangles is that, well, any continuation pattern like the triangle, if you weren't even thinking Elliott, you look for price to thrust out of the pattern. So all that sideways consolidation is normally ended with a sharp move out of it. So as you're probably well aware, like you normally have to be taking a trade position close to the end of a triangle, or have your limit orders in place, or however you trade, because the chances are when the triangle starts to get going, you'll miss the trade. Well, you don't want to be jumping in on the trade. But with the two guidelines I just explained there, we had the triangle and we had the ending diagonal, both occurring at the same juncture. So the outlook would have been, our expectations for price action would have been for a real quick reversal out of this pattern, and that's what happened. So just keep that in mind when I refer to the diagonal pattern about its swift reversal and it trading back to the origin of the pattern, which here was the wave B low. And as I said, price trusted out of it. Confirmation will come from the taking out the wave D low or the wave B low, but we had plenty of key levels on the way down that was adding confidence to the idea that this is what was happening. And so now this is bringing us more up to date. And you can see here we have our zigzag in place. We have a three-wave move down for a W, our triangle, the thrust out of the triangle. It's impulsive, it's sharp, it's counted in 5 waves. It's indicating the trend is down, but price is attempting to locate a low here. The first move up off the low, even on a monthly chart here, it appears to be in 3 waves, indicating the downtrend hasn't finished yet. The trend is still down because we know price trades counter trend in 3-wave patterns. So if we just go down to our weekly chart, this is what we're showing at the moment. We're considering a triangle to be underway here. 3 waves up for wave A. It looks like a 3-wave down for wave B. Back-to-back B wave or back-to-back corrective moves, indicating that a triangle is underway. A flat is the other pattern that can unfold back-to-back 3 waves, and we look for 5 waves to advance in wave C. But once the wave A high here remains intact, the idea will stay preferred that a triangle is underway. As with the US dollar, there's more left to this sideways contracting pattern. So price is going to probably come up, bounce off resistance, locate support, bounce off resistance. It would be more a shorter term traders ideal. It's not going to, there won't be a whole pile of longer term trending going on. But once this sideways pattern completes, once we can count 5 waves in place for the triangle, our expectations will be for a thrust out of the pattern, for a C wave to unfold in another 5 waves, and once them 5 waves are in place, the US dollar could have put in quite a significant low. You can see I've established the corrective price channels on this chart, which is, until we have more price action, it's kind of hard to put a more confident price objective for our wave C or our wave Y. But just going by the channeling, the 0.95 level is something we're probably considering. But for the moment, our opinion is bearish against this wave A high. Once price action unfolds in a 3-wave corrective manner, our focus will remain on lower lows in the Euro-US dollar. And again, you can see while the US dollar and the Euro-US dollar trended quite in a high correlated manner, the wave patterns were very different. So confirming why we should be looking at them individually. A little more work, but if you like this stuff, you just love any new chart that you can put letters or numbers on. So that was Euro-US dollar. Now we'll look at US dollar Japanese yen. This another very interesting pair over the last number of years, and quite enjoyable to watch there as we were analysing it. Again, I'm going to zoom out this time to a quarterly chart. So we're going way back here. But what I want to kind of show is and emphasize the benefits of simplistic approach with our 5-wave counts and our 3-wave corrections is that even on this quarterly chart, we're counting 5 waves down, wave 1, 5 wave down for wave 3, a nice extended 3rd wave. This sideways corrective triangle pattern, A, B, C, D, and E for a 4th wave. We're looking for a thrust out of that pattern. Price is trusted out of the pattern. Minimum expectations, of course, are for the 5th wave to take out the 3rd wave high. So we've got an expectation for wave 3 to come down and take out that, well, the low here. And once these 5 waves are in place, a 3-wave correction is expected. You can see here that back in 2010, the converging nature, the overlapping nature of this 5-wave decline, a diagonal was our preferred pattern under consideration. And that's what happened. It appears that a diagonal unfolded. So if we go back to the guidelines that I'd referred to with our euro-dollar count, the diagonal, our expectations are for price to reverse or to trade back to the origin of the pattern in quite a swift and dramatic manner. Also here in US dollar, Japanese yen, which, you know, there are different time scales here, so don't be thinking that we were putting this towards the euro count, but we have this price thrusting out of a triangle, indicating the 5th wave is underway and the larger degree 5-wave down move is in place. So at these 75, 80 levels, if you're telling people, well, our expectations now are for our US dollar Japanese yen to come up and probably test 125, big picture, like, people think you're crazy because everybody's bearish at that stage. Everybody's bought into this trend, even if they are kind of zooming out and you establish a few trend lines. Do you know, or people are so out of love with this market they don't want to go near it. But you know, we count your 5 waves down, completed correction. You know, you're anticipating a trend reversal. So when everybody else is gone out of favor with that market, or in the opposite stage, if it's 5 waves up and everybody's bought into the trend, you know, you can often become a contrarian where you're kind of thinking, lads, this thing could be reversing, and if it does reverse, it could be big. And if it doesn't reverse, you most likely have a key level or a critical level, so you not have this big exposure to think like, if it doesn't reverse, I'm just going to take all this pain. There's no pain. You know where you're wrong. And on a weekly chart here, we see prices advancing quite an impulsive manner. This is corrective, very corrective nature. Price is taken out to swing high. So basic technical analysis 101, higher highs, higher lows, the definition of an uptrend. Here we're getting them. All the time we're thinking this thing could rocket if the diagonal is correct and if the thrust out of the triangle is in place. Look at that. Price comes up and tests 124, 140. That's another thing, another guideline. When price is correcting the 5-wave advance, the initial support or resistance area that we would look for is the 4th wave at one lesser degree. So not alone are we expecting corrections, we're expecting prices to come and meet certain levels to support our overall analysis. And that would have been the origin of the diagonal and the end of the 4th wave. And that's what happened. We have a nice clean 5-wave advance here for wave A, so we're labeling it an A/1. Once 5 waves complete, we look for a corrective retracement. Something bigger than any of the other corrective retracements that occurred within that 5-wave advance. And price action so far looks to be kind of correct off that wave A high. With the 4th wave at one lesser degree is down here around the 100 level. So, which would be a big long term. We don't have a diagonal to, or there isn't enough information up here for us to kind of be overconfident and expecting wave, or this wave 2 or wave B to come down and test this wave 4 low. Shallow retracements do occur, like, but we would have our Fibonacci retracements and different support levels on the lower time frames for price to come down and adhere to. Here's just the weekly chart now of that impulsive advance. You can see there I have what we call an impulse channel. So not alone can you channel the corrective price patterns, you can also channel the impulse patterns. And when the lower boundary of the impulse channel is violated, that is an indication that the trend of that 5-wave advance is in place and that the 3-wave correction that must correct that 5-wave advance is now underway. Price action of the wave A, so going high, is quite corrective in nature. So it is possible that these 3 waves are just the initial correction within a larger correction that's due to unfold here. if price does not begin to kind of really push lower here to favour our flat pattern. But in saying that, once price advances in 3 waves, we will still consider this correction to be underway, and we'll keep our bias, as we would say, to the downside, expecting the US dollar Japanese yen to remain in a corrective mode, or a bearish mode. So that's US dollar Japanese yen. So now I'm just going to look at Euro Zloty. So this is what I thought was interesting. Now we don't follow this in our everyday coverage, but what we do have is like another rates page within the cross-rate service. And from time to time, when certain subscribers would email in or ask us to cover certain markets, we'd put a count out there and we'd show them and maybe track them on a more long-term basis. But I might put this up there now because I actually thought this was quite interesting. So going back to 2008, we had quite a sharp impulsive advance. This is indicating an uptrend is underway, most likely a 5-wave affair. Since then, price has corrected in 3 waves. That's nice. Probably, if I was looking at this back then, and whenever that was, 2011, I would have had a bullish opinion once them 3 waves were in place and said, wave C now, another 5 waves up. 5 waves never unfolded. We have a 3-wave correction here for wave B. Straight off the bat there, flat or triangle are 2 corrective patterns we would be thinking. But if price doesn't unfold in 5 waves and the wave A low remains intact, triangle, that's what happened. We get another sideways affair for wave C. The wave A low remains intact. Now a 3-wave advance for a D wave must end below the high of the wave B. So if this D wave is in place, I've established a trend line. Wave B, must remain intact, and we have our wave E down. That would complete the 5 waves, the sideways nature for this triangle pattern in the B wave position. So the very same measurement that I refer to in our Euro-US dollar count, the E wave of the triangle often travels 0.618 times the Fibonacci measurement of the triangle C wave. So I have that measurement put out there at 4.1218. That's just an objective for this E wave to come down. But more importantly, we want to see price decline in 3 waves for wave E. With our stop, our critical level, the wave B high at 4.5969. Once a 3-wave correction is in place for wave E, this market could get very interesting because once a triangle is complete, we expect a B wave to thrust higher in 5 waves and take out the high of the wave A. That would be minimum expectations, but we could put on our A equals C measurements, and then our minimum target being the 4.9336, but more than likely price to head well above the 5 level. If price comes down and takes out the wave C low, that would probably, would give reason to be concerned about this triangle count, and if it took out the wave A low too, would negate the pattern itself. As we saw with the Euro-US dollar, the longer-term bullish outlook would not be negated until price took out the wave A low. And but in saying that, within our smaller degree patterns, we would have reasons to think that price was playing ball, or if price was doing other stuff. But for now, that would be our broader outlook. Now, so that's my presentation. Thank you very much. I hope you've enjoyed it. As I said, what I wanted kind of more for people to get out of this was the idea of 5s and 3s, and that zooming out and getting a picture of the larger degree trend can be very beneficial and quite important, and that the wave principle does not have to be as complex as a lot of people make it out to be. Remember, there are 3 rules, and if you stick to them rules, you keep yourself out of a lot of trouble. And all too often, that's what I see when I look at other people. People send me in charts, or if I look at the websites, or I look at various stuff, and one glance at it, and I'm like, why is he allowing for wave 4 to overlap to wave 1 there? There's no reason. And anyway, so I'll take some questions if you have questions with regard to what I've covered, or if you have any questions with the wave principle in general, or whatever. Thank you very much.
Jeśli macie Państwo jakieś pytania, to tutaj będą 2 osoby po 2 stronach sali. Proszę podnosić rękę, wtedy będą podchodziły poszczególne osoby, w zależności, która to będzie część sali. Prosimy.
Thank you very much for this excellent presentation. And my question is really very
prosimy mówić po polsku. Będzie to tłumaczone.
Dobrze. Chciałam tylko zapytać, czy nagrywana jest ta prezentacja i będzie do niej dostęp później?
Yes. Anyone that came today to the presentation will have access to it. Yes.
Thank you very much.
Thank you.
Proszę o podnoszenie ręki, jeśli Państwo chcą zadać pytanie Michaelowi Maddenowi.
Michael, jaka jest taka kluczowa przewaga, co decyduje, że teoria fal Elliotta jest lepszą teorią niż inne, niż pozostałe?
Sorry, what makes it better?
Dlaczego teoria fal Elliotta jest lepszą niż inne teorie?
Well, what makes it better than any other theory is it's been around since 1930 and very little has changed. It's still the same 5 rules. Thanks to Bob Prechter at Elliott Wave International, we have done an awful lot of research and we come up with like more guidelines, just more useful ways of maybe applying the wave principle, but not with regard to new rules or the basic model or the building block. It's a testament to time is one thing. It allows me to cover any market, any time frame, establish any trend, but the key thing that I think sets it apart from a lot of other theories, and I have studied like throughout my technical analysis career, when I did study market harmonics and Fibonacci and supply and demand, support and resistance, I went through a lot in my education base. And I came across Elliott, sporadically, maybe mentioned here or mentioned there, and people would say, "Oh, it's too complicated, too hard. It'll just dishearten you." So, okay, I was like, I had so much to learn anyway. I was like, okay, I just don't need that. So, as I got more confident, and as you do with technical analysis in general, you start being able to just see stuff, and it goes through your mind quickly, like chart patterns or like trend lines or candlesticks. So you don't really have to think about it as much. So by the time I came across Elliott, and I think I looked it up online more or less and started reading a Wikipedia thing or something crazy. And as I was reading it, I was like, this just makes sense to me, because I had a good foundation of technical analysis behind me. And what it done then was it incorporated all the other like technical analysis techniques that I was kind of exposed to. It was basically put them into a box for me, personally for me anyway. And I was talking to certain people then that were instructors at the time from various classes I was taking, and it kind of occurred to me like that I had got the book at this stage, but the basic rules and the basic concept that I was kind of getting they just didn't give themselves the time to get into it. I don't know what reasons they were for. Like, maybe they said, look, EWI have their own thing, and I don't know. But so I went out on my own then, and I put my head down and I said, look, I'm just going to give this a bit of time. I'm going to learn it off. It takes a while now to get it all registered in your head, and I did that, and just the 5s and the 3s started jumping out at me. One thing I really found beneficial was the channeling technique, because I like drawing on charts. I always did. I like patterns. So this idea of being able to kind of confine an impulse pattern to channels, confine a corrective price action to channels, and to the choppy nature, break it down simply. I've been lucky now because I got exposed to some of the best analysts out there, but Jeffrey Kennedy and these guys, that's all they do. Like, things get hard. It's my job as an analyst to write about squiggles every day and say, look, this could be this happening, this could be. But generally, we zoom back out and go, but look, this is our 5 waves up, these are our 3 waves. Okay, I've got to make out all this other stuff on an individual basis, but the trend is up. Keep it simple. And it boils down to that at the end of the day, like keeping it simple. And getting back to your question, sorry. And then the most important thing that I feel that the principle does bring is the levels of knowing you're wrong at that level. At 1 pip below that level, you need to get out of the market, reevaluate it. And if you're right, you have various levels that you can put out there, like Fibonacci extensions. Price must take out the wave 1 high, 5 waves are unfolding for wave 3. So I've got targets. So as a trading guy, I want to stop, I want to know when I should enter the market, and I want to know where the market could go and how it could even go there. And I don't know, does anything else do that for me? So, thank you.
Czy ktoś z Państwa ma jeszcze jakieś pytanie? Już sekundka.
Dziękuję. Ja mam pytanie dotyczące warsztatu. Sposób dokonywania mierzeń, rozszerzenia fal w Elliocie i poprzez współczynniki Fibonacciego. Sposób, który ja stosuję od dłuższego czasu, uważany przez wszystkich, nazwijmy teoretyków, praktyków, jako coś, co ucina palce i rozwijane błędnie. Faktem jest, nie spotkałem jeszcze nikogoś, kto by mierzył w ten sam sposób, jak ja to robię. Niemniej jest to metoda, powiedziałbym, sprawdzona i daje się albo ma miejsce, potwierdza swoją skuteczność na wykresie. Troszeczkę jakbyśmy przecofnęli się do, przepraszam za rozwiązłość pytania, ale chciałbym po prostu powiedzieć, o co mi chodzi i szukam potwierdzenia, szukam kogoś, kto mógłby potwierdzić albo zaprzeczyć, czy robię coś źle, ale skoro sprawdza, wydaje mi się, że robię jednak to dobrze, ale mimo wszystko rozwinę troszeczkę. Jeśli popatrzymy na wykres dwuwymiarowy, a więc impuls, korekta i impuls niejako z góry, sprowadzając impuls do punktu na wykresie, mamy tutaj 2 odcinki podzielone punktem albo kawałkiem odcinka. Jego długość nie jest istotna, bo rozmawiamy tutaj o odcinku mierzonym w czasie. I teraz tak, jeśli mamy tutaj 2 odcinki, ich stosunek do siebie wynika z podziału Fibonacciego. I ja stosuję rozszerzenie w ten sposób, że mierzę długość odcinka, traktując go odpowiednim rozszerzeniem Fibonacciego, dając w ten sposób ekstrapolację w przyszłość. Szukam kogoś, kto albo potwierdził słuszność mojej metody, a rynek to weryfikuje i potwierdza, ewentualnie szukam osoby, która by mogła zweryfikować mój pogląd na to, aby wymienić się, nie wiem, poglądami, doświadczeniem, czy ewentualnie takim samym sposobem postrzegania tego samego sposobu mierzenia. Nie wiem, czy mówię zrozumiale i czy jest to dobrze tłumaczone, ale chciałbym się dowiedzieć, w jaki sposób Pan to dokonuje, bo przyznam się szczerze, nie spotkałem jeszcze nikogo na rynku, kto dokonywałby w ten sposób mierzeń, powszechnie uważanych przez praktyków, teoretyków za błędny. No niemniej upieram się przy swoim, ale po to prawdopodobnie poznaje się pioniera po nożu w plecach, w związku z tym może coś, chciałbym to generalnie metodę rozwinąć. Dziękuję.
No, that's a good question. I hope I understand it, or maybe this guy is not translating it right. But I had to kind of, keep this not keep it basic, but you know what I mean? I didn't want to start bringing in Fibonacci projections and retracements and stuff like that. But there are, there are Fibonacci retracements and projections. While we don't they're not rules. So if wave 2 is expected to retrace wave 1 by 61.8%, like if it's, you know, it's guideline, it's not a rule. So you're not looking at pinpoint retracement levels. But in saying that, I'm not sure if you're familiar with my work or whatever, but you know, you're looking at different patterns at different degrees of trend. Each of them patterns will have their own Fibonacci guidelines and projections. So if you can analyze the different degrees of trend at all the different times and come up with clusters of Fibonacci resistance, price clusters, okay? Them clusters, then the more Fibonacci measurements or equality measurements that come into the same level make that level a more important level. That and the other guidelines that we would have for the wave principle. So with regard to time, the very same measurements that we use with price is the same. So we look for a 61.8, 50% retracement of wave 2 of wave 1. Well, we could project that in time too. So we'd expect wave 2 to maybe unfold at 50% the time it took for wave 1, or 61.8%. And then projections for the third wave, our initial projection would be 1.618 times the distance traveled in wave 1. So there are Fibonacci projections we put out there. And that's what I would use. You can look at Fibonacci, because Fibonacci out there at the end of the day, there's no book that just goes, this is it, guys. And one thing that took me years to kind of figure out was that, like, there's no right way to put, like, this is where the top goes, this is where the bottom goes. It's like what this gentleman is saying. What works for him, and he thinks he's established a recognizable way of using, or, you know, a confident way of using it as he's trading, is obviously testament to. And if it works for you, that could be it. We can talk later if you want, or if anyone wants to talk outside with regard to Fibonacci application. But we at Elliott Wave International, we do use Fibonacci application. Well, of course, it depends on the analyst, but you know, we have works by Wayne Gorman that go through the golden ratio. Because as I said earlier on, the wave principle is governed by the Fibonacci measurements. Have you ever heard of Constance Brown? She's a trader, a US trader, and she has a Fibonacci book out by Bloomberg, and it's actually quite interesting. And she uses Fibonacci on time and on price. The same Elliott waves, or the same way as the Elliott guidelines suggest, but she too then adds her own way of creating clusters for support and resistance, which is quite interesting. She's another Elliott Wave practitioner, and she worked at Elliott Wave International, and she's a high flyer in America at the moment. But so Constance Brown, she'd be one, and maybe our own stuff at Elliott Wave International. I hope that answers your question.
Drodzy Państwo, czy mamy jeszcze jakieś pytania?
Tomorrow at the workshop,
Yes.
Yeah, tomorrow at the workshop, actually, I will be using some of the Fibonacci measurements to show where I expect price to go. But I won't be getting into a lot of detail. But if I do finish early tomorrow, you know, hopefully I could bring up some I have my computer with me, real life charts, and show up some Fibonacci measurements of what I'm trying to explain, or you can show me yourself. Okay, sorry.
O 9 rano w sali numer 3 na 3. piętrze. Jutro są faktycznie warsztaty z Michaelem. I może ostatnie pytanie. Michael, jak dużo instrumentów, rynków analizuje każdego dnia Elliott Wave International jako firma?
I think we are the world's largest financial forecasting firm. That's what we say underneath the thing anyway. But we cover everything, I think. We don't. Yeah, we cover European markets. They break it down into newsletters, and then like a subscription, a trader's kind of maybe based thing where intraday charts are updated on a regular basis. But we cover all the major forex pairs. We cover European stock indexes, maybe I can go through maybe 5 or 6 of them. We cover the US stock indices. They cover the metals markets, all the precious metals, some industrial metals. They cover the energy markets, oil, gas. What else is there? Commodities. Yeah, they cover all the commodities, all the soft commodities, all the hard commodities. And actually, I couldn't talk highly enough of a friend of mine now that I work with, Jeffrey Kennedy. He has a product called Trader's Classroom. And if you're into like technical analysis or into the wave principle, I personally, and I've kind of tested a few of them. I haven't come across somebody now as good as this guy. His presentation qualities, he's probably one of the best wave analysts in the world, and good all-round guy, nice guy. You can write in questions to him. He'll cover them questions then I think he does about 5 sessions a week, probably between 15 minutes to 30 minutes, and then once a month he does a live event where it's a virtual room online and you can get in, he'll cover a topic, and then all kind of based around the wave principle, but he includes other technical analysis techniques as well, because like myself, he's CMT'd, he's got the CFTE and he's MST, like he's got all the qualifications, so he's like me, loves technical analysis, loves teaching, and just loves talking about this kind of stuff. So they do have quite a lot of stuff, Elliott Wave International.
Dziękujemy w takim razie bardzo serdecznie.
Thank
Przed
you.
nami wystąpił Michael Madden, Elliott Wave International. Wielkie brawa oczywiście.
Cheers.